Good afternoon, everyone. My name is Sebastien de Montessus. I'm the CEO of Endeavour Mining. Endeavour Mining is the leading West African gold producer, one of the top 10 gold producer in the world, but focused geographically in West Africa, operating 6 mines, target to produce about 1.4 million ounces this year, one of the lowest all-in sustaining costs in our peer group, and therefore generating strong cash flow, allowing us to pay healthy dividend to our shareholders.
Yeah, I saw the headline, 43% increase up to $100 million. We better hit us with the kind of first half numbers because there's a few things I want to get stuck into with you.
Well, I think in terms of the key theme behind the Q2 results is a very strong operational performance. Again, well placed, probably compared to the rest of the sector to meet our guidance for the 10th consecutive year. So reiterating our guidance for production and also our guidance for cost. Overall for H1, our all-in sustaining costs were at 900. We've been able to generate a very strong cash flow, ending the quarter with a net cash position of $217 million. And on that basis, we were able to increase significantly our dividend by 43% compared to last year, distributing $100 million for H1 to our shareholders and another minimum $100 million for the second half of the year. So a total of $200 million that will be distributed in dividend for H1 and H2.
Okay, you seem to be bucking the trend because most companies have come on and talking to me about the inflationary pressures that they are facing, market pressures are facing, costs going up. You are at the lower end of your AISC guidance. How are you managing that?
Well, I think it's a combination of several items. I mean, first of all, we're not immune. To the inflationary environment. We do face some inflation. If you take, for example, fuel price, I think that's a total impact of about $50 to $60 an ounce. So it's significant, and we see that across a number of chemical supplies. To the mine and to the production. But on the other side, we are able, to improve because we've got young assets. We are able to improve our operations. We are able to improve our working capital. There is a lot of efforts which is put on operational performance and also on continuous improvement. We're also benefiting from a nice, I would say, FX impact because we operate in French West Africa. That means that we're pegged to the euro. 60% of our cost base is pegged to the euro. So we've been benefiting from a lower euro versus dollar, which had positive impact also in Q2. So overall, I think it's all about putting the right efforts to be able to compensate for those inflation.
Okay, you've always been a slave to the numbers. You always deliver it. Quarter after quarter, you've always delivered. But with cash coming in, you can afford to do things better, right? You can pay to improve processes and systems and so forth, equipment, etc. But the cost side of thing, FX is one thing. I guess a lot. The fuel is doing what it's doing all across the world. The cost of personnel, I suspect, is going to be lower than elsewhere in the world. But what else are you doing to kind of keep those costs down? Because you don't want to be like cutting costs for the sake of cutting costs and affecting or damaging your potential further down the line. And again, it's something that we've seen, people taking shortcuts. So what are the things that you're focused on?
Sure. I think a big part is, in fact, better performance at some of our mine sites. We've got, over the years, we've been able to get a portfolio with an overall average low all-in sustaining cost. We've got 3 key mines. If you take an asset like Sabodala-Massawa in Senegal, which is producing over 350,000 ounces at less than 700 all-in sustaining cost. We've got our 2 historical mines, Houndé and Ity, which are in Burkina and in Cote d'Ivoire, which this year are producing the plant. The throughput has been increasing and therefore helping to reduce all-in sustaining cost. Both mines might reach up to nearly 300,000 ounces of annual productions for each. So we still have, levers in our portfolio to be able to increase the performance of our mines. So it's not about just, trying to reduce cost for the sake of reducing cost. It's really driving better performance across our mine sites.
Right, and I guess what I'm trying to get at is how much of this is of the heavy lifting is being done for you. If you're producing increased grades, that's going to do some of the heavy lifting for you in terms of driving the AISC down. But if it's increased performance from your team, that's the bit that interests me, because it suggests there's something that can be done in the future, applied in the future to some of your other portfolio projects where it may be more of the organic growth. So that's why I'm kind of interested in it. But here's the question I want to get to. So numbers are good. You're dishing out dividends. I think you talked about a huge share buyback of like $38 million so far in the first half of this year. That's all good, right? You're finding the best way to deploy capital, but your share price has been affected like everyone else, right? So you're doing the share buybacks. You're working at these huge dividends. You're producing a lot of with huge frustration. Sure, I know, but it's just as an investor looking out, and I'm trying to say, well, I've got to pick the best companies. Yours, on paper, sounds fantastic. I'm getting big dividends. You're doing share buybacks. You're producing a lot of ounces. You're throwing off a lot of cash. You seem to be in control of things in West Africa, where South America seems to be doing its best to shoot itself in the foot more broadly, and even difficulties in tier 1 jurisdictions like North America. It's all going swimmingly, but yet the market is nervous. It's risk off. It's cash in hand, even for a company like yours. It's super frustrating, right?
Yeah, it is. I mean, that's exactly part of the discussions we had with the board. I mean, on the board we've got two significant shareholders that controls nearly 27% of the company, and they're frustrated, which you can understand. But at the same time, they look at are we doing things correctly? And I think the answer is yes. How are we doing compared to the rest of our peer group? And I think that since the beginning of the year, with the second, best performance, or the less underperformance, I may say, for the sector, since the beginning of the year, after Yamana, because of the acquisitions that they are, going through with Goldfield. So, yeah, I would say that it's frustrating, but at the same time, if you're doing the right things, there is a point where the market, comes your way. So we just need to continue like that. And one other thing I just wanted to highlight on the question of how do we mitigate inflation and so on. We acquired, two companies, Semafo and then Teranga, over the last 2.5 years. So it takes time, to continue to turn around and improve around those assets that we acquired. One good example is, Wagnon. We have a policy where we grow local talent. So we do grow as much as we can local talents. Teranga, for example, was at one of their mine site, Wagnon. They were operating with about 75 expatriates. We're now down to less than 40 because we've been able to turn around, the mine site and bring on board very strong local management teams. That in itself, is good for the operations, is good for the stakeholders that we're employing, but it's also very good on the cost side. That's straight, $4 to $5 million saving, and this allows to compensate for a lot of inflation. So what we see around this, inflationary environment, it's all about how much, effort you put in trying to continue to improve your operation. You just can't say it is what it is. Inflation is going up, my cost is going up. No, you've got a lot of leverage, but you need to put a lot of efforts into it. So either you do it or you don't. Okay,
so who's selling? Because what I want to understand is, should I be thinking more like an institutional investor and be sitting and riding out this cycle because the fundamentals of your story are good? Or if it's, and therefore if it's retail selling, I can understand that. There are different pressures in terms of, disposable income, discretionary spend, et cetera, or nervousness more broadly. But if there are institutions selling, why would they?
I think, one of the key area that, when we look at the gold sector, is the extreme volatility that we've been through over the last 6 months, which means that when gold price goes down, equity goes down. But the same way, if gold goes up, equity goes up. And I think that what we're probably on the verge is, seeing gold price going up, and therefore the best gold equities to significantly outperform the gold performance. So, my advice would be, pick the companies that you think on the long run, not just for 1 quarter or 2 quarter, have consistency in delivering, results. That's the only way to be immune to the high volatility in the sector. Because if you pick the best ones, you know that, compared to the sector, you'll be doing better. And if your vision is that, gold should go up, then you've got the right investments in your portfolio.
Okay, so if I look, as you said, it's kind of all relative at the moment. Your peers are down, the good companies are down, the bad companies are down, your peers are down, you're down at the moment. Are you inclined to take advantage of the situation? Because you're in the rarefied air, you're producing a lot of cash, right? You've talked to me in the past, obviously the smart way in terms of return on capital invested is organic growth. But in an environment like this, are you tempted to look at some of these, let's call them stranded projects, i.e. whether it be cash constrained or the fact that the markets are just not in their favor at the moment? Maybe you could pick something up cheap. Have you changed your thinking, or have you opened your mind to that sort of thought?
I think gold price environment doesn't change really our thinking around strategy. Our preferred route remains clearly organic growth, because this is where you get the best returns. That's for sure. We are lucky enough or blessed enough to have, and we've been working a lot on having a significant, I would say, pipeline of growth projects, which means that we're not short of ideas, for the next few years. We're currently building the expansion of Sabodala-Massawa in Senegal. We just announced that we will publish our DFS for our greenfield project, Lafigué, in Cote d'Ivoire in the course of Q3. So we've got 2 significant projects which are coming up nicely. 2 projects that will continue to provide significant ounces. Lafigué will be around 250,000 ounces for more than 10 years at below 900 all-in. So all those projects are contributing to maintain, I would say, our low cost. But at the same time, we continue to be opportunistic. If there is something that comes up, that is, appropriate for our portfolio. The only thing is we're not seeking, to just grow for the sake of growing in terms of production. It's all about, does it improve the quality of the portfolio? If it meets, our return on capital employed targets and it can improve the quality of the portfolio, then yes, of course, we will look into it.
Okay, well, let's talk about that layering. Okay, so Sabodala-Massawa, DFS came out in Q2. You've got the Lafigué DFS coming out in Q3. And it's going to give you a good sense of the kind of costs involved for these things. And I'm just wondering, in this environment, how do you play it? Because, you could delay that capital allocation because it just doesn't make sense at the moment, and wait to see how this inflationary environment plays out.
No, it's a very good question. Initially, the market was expecting us to come out with construction decision for those 2 projects at the beginning of the year. And we've been delaying them simply because we wanted to make sure that we had a proper control on our capex, and we didn't want to see, launching a project and then coming back announcing that suddenly capex are up 20%, 30%, or delayed. So instead of coming out with those 2 construction decisions at the beginning of the year, we only got, the first one, Sabodala-Massawa, at the end of March, at the end of Q1. What is interesting, and for me, it's a good example of how we're seeing for the next one, is so far we've committed about a bit more than 30% of the capex, and we haven't seen any increase compared to our budget, which means that when you are smart, you are able to contain, I would say, this inflationary environment. So for Lafigué, we said, we need more time because we need to work around the capex, and we need to make sure that it does meet all the criteria that we want for greenfield projects. I think we're getting there. I'll give you one example. We had initially a $15 million cost for the camp for Lafigué. We were able to find one at $6 million, which was sitting in Turkey, which was initially for Rio Tinto that they decided, not to move on. So, by being a bit smart and finding the right ways, we were able to reduce then, more divide by 2, just one line, in this capex line. So, yeah, we're getting more and more comfortable that, when we will come out, for this second construction decision, we'll have enough certainty around our ability to deliver on target and on time.
So can we just come back to something we hit upon earlier, which was this kind of West African factor? Because again, with my investor hat on, that's why I like having these conversations. I need to understand where's the best place to deploy my capital, which is there. we've seen some real negative stories coming out of South America, out of Mexico, out of Ecuador, out of Peru, out of a few other countries in South America. We've seen delays on projects and First Nations issues in both Canada and the US in these tier one jurisdictions. Africa, in terms of doing business, are you intent on staying focused on Africa because that's what you know, or are you fixed on Africa because it's easier to do business there?
I think, you always need to assess, where is your competitive edge, versus our peers. Clearly, I think we've got, a strong understanding on how to operate in West Africa in particular. This is why we've been concentrating our efforts there. The reasons are, first of all, if you recall, it's the second largest gold production region in the world after China. So it's not something you can avoid in terms of, if you want to invest in gold, you can't just say, I'm not interested in West Africa when it's the second largest gold region in the world. Second, it's been for the last 10 years the biggest one in terms of discoveries. So if you want to make organic growth, those are the areas you want to focus on. Those were two, critical areas. The third one is clearly what we've seen is if you're agile and if you're able to understand your stakeholders, you can go fast and at low cost. And that's what I think what we've been demonstrating over the years and the years. Each time we've built a mine, whether it's Houndé or ET over the last few years, we came out, on time, on budget. And each time probably, it took us, 40%, 30% cheaper than building the same project in North America. And probably took us about half the time in terms of lead to construction and to first gold pour compared to North America or Australia. So yes, it's a very, very, very attractive area for discovering, building, and operating.
How do you feel about the public markets? Again, in environments like this, emotions come to play, right? And decision making gets affected by not just investors, by retail investors, by institutional investors, but also the boards themselves. Would you, if you did this again, would you run it as a public company?
Well, I think it all depends on what's your ambition. Being a listed company helps you, grow quickly, your business. If you think about it, less than 6 years ago, we were a $250 million market cap company. We're now about $6 billion company, integrated into the FTSE 100. In order to do that, given the amount that is invested in the business, we invested probably over $1 billion in capex and exploration. You can't do it just with private funds. So the market has been, from that perspective, has been efficient, to help us grow quickly. Now it comes also with some downside, volatility, which is not easy. But I think where we've been mitigating that is having, two strong shareholders that have been backing us, since the beginning. So when you've got, close to 30% of your register, which is controlled by, two entrepreneurs, it helps you keep, an entrepreneurial spirit, so that you remain lean, agile, focused, and really onto what is important for any companies, which is generating cash flow and returns.
Right, and those two main shareholders, they understand the project personality, right? The who you want to be. You want to be entrepreneurial in spirit, but obviously deliver on the numbers, which you have been doing quarter over quarter, okay, which is great. What about these institutional shareholders? Do they like that? Are you getting any pushback from them in terms of the strategy? Do they want you to do M&A because it feels good, it sounds good? Other people are doing it. You mentioned Yamana Goldfields. It captures people's attention. Whereas the kind of organic growth, it's quietly, steadily getting on with the business of doing business, but it doesn't have that sex and sizzle to it. So. Do you come up against that?
It's a very good question, and my experience is you've got very often you've got conflicting strategies between your own shareholders, in particular investment funds. So what you need is to make sure that you have your own vision, and hopefully that aligns with the one you want to attract. Give you one example, some people will tell you, oh, do buyback, don't do dividends. Either will tell you, do dividends, don't do buybacks. Others will tell you, don't hedge because I want the full exposure, to the gold upside. But those which are saying that are exactly the same ones which are selling your stock when gold price is going down. And therefore they're not there anymore, when you're going into the downturn. So I think what's very important is to be very, very strong on what are your priorities, outline your priorities, and then be sure that, the right investors, are coming and in your register. Because otherwise, the difficulty or the mistake is trying to follow, the flavor of the day in the market, because the flavors change, every time. Remember, 10 years ago, it was all about size, be bigger, be bigger, be bigger. Returns were just miserable. It was absolutely a disaster for the industry. So people shouldn't have listened, to investors telling them be bigger just for the sake of being bigger. So I think we need to look at, gold mining companies as any other companies that can compete with other sectors. So all about, returns being properly managed, cash flow generation, and rewarding shareholders. If you do that, like any other business, no reason why investors shouldn't be attracted by your proposal.